Hey guys, this is the introduction video to stacks. So let's get into it. So I wanted to talk about the basics of stacks on my channel first before making some of the further videos discussing what each element is, each part of value investing, right? So let's first talk about what really stacks are. And this is the first big topic because it is important not to forget that when we buy stocks, we don't actually buy stocks. We buy a partial ownership to a company, which means that you own the part of the company. And stocks are not lottery tickets. And that is why it is important to look at the underlying business fundamentals. That is why we do stock analysis, company analysis, and that is why we try to find catalysts that will drive up the price. Now, catalysts might be just extreme undervaluation, which pushes the price up, or other things like index inclusion, shares buyback, and other great stuff for shareholders, which the market notices and then pushes the price up. Okay. So, goals of a value investor. So the first goal is to buy great companies with great fundamentals. We already talked about this. You want to buy, like Warren Buffett said, you want to buy amazing company at fair prices. Of course, ideally at amazing prices. But the thing you want to look for when buying stocks is the fundamentals of the underlying business. Okay, the second one is buying companies below your estimated or your calculated fair value and recognizing catalysts that drive up the price, as I already said, to make gains from that. You also want to recognize misvaluations. This is very important because the market prices things inappropriately, and that's when you want to buy when the market is valuation of a stock is really low, although the value of the stock is really high. And that's why value investing works. You buy something at a low price, although its value is still high, and the price is going down because of a short-term problem in the company. Of course, this is nothing major. And let's go on to the mentality of a value investor. So, first thing is first, this is the most important thing. Even Warren Buffett said this on an interview on TV, and that is to ignore short-term losses and focus on long-term gains. Or rephrased in the words of Warren Buffett, if you're going to do stupid things when your stock goes down, you probably shouldn't own a stock. And you really need to focus on the long-term gains, not on the short-term losses, which may occur from the market volatility and fluctuations. This is also a very important one. Buy, not sell the dips. Right? You want to buy the dips. You don't want to panic sell when everybody else is selling just because something happened in the market. Because usually, when the market goes down, like 20%, it is the best opportunity to buy. Other than that, the better opportunities are only in financial crisis, where the stock market can drop down bigger margins, like even 70 or 80% in big crisis. So you need to take the opportunity when great companies are at low prices. You cannot miss this opportunity because you can, but it will impact your gains over the next few years, because your biggest gains by years are in the years after a financial crisis, because that's when you can really buy the great companies at great prices, right? And finally, I have a rhetorical question. So, if you buy a company whose fundamentals you are confident in, but after you buy it, it dips 50%, but the value of the company stays the same, what what do you do? I mean, do you sell it because price is down 50%? I mean, something major must have happened. Of course, it is important to look in to what happened, but usually when a stock you own dips by 50%, it is a great opportunity to buy the already undervalued stock at an even greater price, because usually when you buy something, you think it is undervalued. Of course, after it dips 50%, it is even more undervalued, giving you a very nice investing opportunity. Okay. We already started on this, but let's talk about recessions and crises. Um, Not much on this slide, really, but it is very important to buy in the dips of the crises and recessions, and you cannot miss out on these because the years after the crises, should I say, are the best profiting years in your investment career. And they're really nothing to be afraid of, because if I'm correct, in the last 100 years, there were only 15 years of crises, while there were 85 years of continuous bull markets, which is why it's not very stressing, um, because after you buy the crisis dip, you can get back up to your gains in just a few months or in some longer crisis years. But still, after the price goes up, it is probably going to be your most profiting year. And also, it is important to continuously buy the dips, because if a market goes up and then it starts to go down, but you think that the economy is turning around and buy here, but then it goes down again, but you miss out and then it goes up again, you need to buy everywhere. You need to buy here, you need to buy here, you need to buy here, and you need to buy here. You need to continuously buy, because then your price averages out, and you make the most out of the opportunity. Because, of course, you're going to buy $100 here when the price is even lower, maybe, I don't know, $200, and so on and so forth, right? So the lower the price is, generally, the more you are willing to buy. But also, the lower the price, the more you can get with the same money. But yeah, on the bottom, of course, is the best opportunity to buy. But yeah, you really shouldn't miss out. Okay. Now, finally, let's go to some quotes that some very famous investors said, and I think that these are very important to take into consideration, and they're also very interesting. So the first one, from Warren Buffett, is be fearful when others are greedy, and greedy when others are fearful. Uh, so this is very nice, a very nice quote, and it basically says that when the market is too enthusiastic, it's probably going to go down because everybody already bought. There's nobody that can, there's nobody more that can come and then buy more, because people are already fully invested. And when people are fully invested, it causes overvaluation in the market, which means that if the market is overvalued, it simply goes down because of the overvaluation. Now, people can blame it, for example, on bad events. Like, for example, in COVID, the price has dropped because of COVID, right? But I think that it was just from the lack of proper value in the market for a long time. Uh, Now the crisis in 2020, or when COVID happened, it was not very major. It didn't really um, the time that it took for the stock prices to go back up again was actually pretty short. So I wouldn't really even consider it a crisis. Probably the shortest crisis in history. But yeah, anyway, so this quote basically says do the opposite of what the public does and of what everyone does, and you have a good chance of succeeding. Because obviously, the stocks that everyone wants are overvalued. Okay, this one, is also very nice. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. This quote is by Benjamin Graham, who was Warren Buffett's teacher for investing. He's also very famous, was very famous, should I say. And this quote basically means that in the short run, this is the value of the stock, of the company. But the price goes like this. And this quote basically says that in the short run, you're going to have downs and you're going to have ups. But in the long run, the market is going to hold the value. And that is why everybody expects a crisis right now, because everything is overvalued. And the second part of this quote is that in the long run, it's a weighing machine because the weight just continues to go up with the value. The next quote is also pretty amazing. It's by Paul Samuelson. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. This is really a staple of investing, and I love this quote because investing is not fun. And it's about of course, it can be fun for some people, but generally it's not you don't invest to have fun, right? You invest to make money. Or I don't know, yeah, to make money, right? So investing is about the long run, which means that you will have to skip a lot of opportunities, companies that are not the best, but you're just going to have to say, this one doesn't meet all my criteria. Let's go on to the next one. And analyze company by company in each phase of the market. And rarely will you buy any stocks, really. It's just like you just have to wait for the crises and buy only when everything is exactly right. Okay, guys. So, hope you enjoyed this little video I made here. Of course, the upcoming videos, are going to be a little more complex. So, hope you understood everything. And in the next video, we are going to take a look at my platform where I analyze my stocks, and we're going to take a particular look at one stock that is that has had a 52-week bottom very recently, and we're going to analyze that company and show you what all of the features are. So this was a bit of a longer video, but anyway, hope you enjoyed it, and I will see you next time.